If we slip into an outright recession, which would be very deflationary, the Fed will probably cut rates back towards the zero bound. I'm not going to say they'll go right down towards zero, but what's more important is that the Fed will cut rates way more than what's priced in to the swaps curve or the bond market. So that view holds. And again, in this business of economics, your assumptions drive your conclusions. So if we get a recession, yes, 500 basis points or something of that order of magnitude over the next 24 months. And even if we get this elongated soft landing and inflation comes down, I think at a minimum, the Fed will take the funds rate down towards its own estimate of neutral or equilibrium, which is 2 5/8. And so, all roads lead to much lower interest rates with or without a recession. The most important correlation to the 10-year note, there's a bunch of correlations. Fiscal policy has a correlation, wages, inflation, core inflation, the economy. But the most important correlation, 90% correlation, is with the direction of monetary policy. We went into this bear market in treasuries because of the Fed taking the cost of carry away so aggressively. And of course, in response to everything that was happening in the economy and inflation, but monetary policy bulks very large. So the whole curve will downshift. The biggest declines in rates will be at the front end of the curve, as is usual in an easing cycle, and especially in recessions. But the whole curve will move down. Yield curve will pivot from inversion to positive slope. I guess you could argue that would be good news for the financials. However, the best total return potential is going to be the long end of the yield curve. Even though the yield doesn't go down as much as the front end, you get the price appreciation and the convexity giving you what I think is going to be a double-digit return in bonds over the course, in long-term bonds over the next 12 months. And the Bank of Canada probably is going to start cutting rates too. And not long after that, we'll see the Bank of England. I think that the Fed is going to drag its heels a while longer, but I think that you've had other central banks already begin this process. The Fed doesn't have to lead it. But in 6 months' time, we will be talking about a global backdrop, lower policy rates. Sometimes the Fed leads, sometimes it lags. This time around, it's going to lag. But it doesn't really have an influence on the ECB one way or the other. They're responding to their domestic considerations. And the Fed's going to do likewise as far as the U.S. backdrop is concerned. The fact that you're seeing, especially this year, when people talk about the bump in inflation, 100% the deviation in the inflation numbers this year benchmarked against the disinflation trend that we had last year, all of it has come from insurance premiums, principally auto insurance, but also health insurance and tenant insurance. And so and the biggest one has been auto insurance. Auto insurance costs are up 22% year over year. And that has nothing to do with the economy. It has nothing to do with Fed policy. It has nothing to do with liquidity. It's the insurance companies responding to their horrible claims experience over the course of the past couple of years. And it's very, very idiosyncratic, as it is with those other two aspects, health insurance premiums, which looks to be a seasonal skew, and tenant or homeowner insurance, which seems to be, you could argue, related to what's happening in terms of climate change and claims associated with hurricanes and tornadoes and floods, so on and so forth. That's not inflation that the Fed can really control. Of course, it would be problematic if it fed into inflation expectations, but I'm looking at the 5-year and 10-year, TIPS break-even levels in the market for real return bonds, and they're basically 2.3%. They haven't budged in really 3 years, despite all the hype over inflation. The longer-term market-based inflation expectations have been broadly stable. On top of that, what makes the U.S. special is the rental components. Europe does not have OER in their data. They don't have owner's equivalent rent. They don't have a question. The question in the CPI in the United States for the sample of homeowners is, what do you think you can rent your unit out for if you could rent it out? It's a fuzzy number. It's part of the index. It's a 27% chunk. Canada does not have OER, and most of the Canadian inflation measures have already moved to or even below the Bank of Canada's target. And the Eurozone doesn't have owner's equivalent rent. Only the US has this, bizarre and dominant component. And the rental numbers are subsiding, but it's been painfully slow for a variety of reasons. But it's really a rental and insurance premium story. Everything outside of that is pretty dormant. And in fact, if you looked at the US CPI on a harmonized basis in the same way that they do it in Europe, core inflation in the United States on a European basis is running at 1.9%. And that's even lower than it is in the euro area. And the ECB, like you said, is about to cut rates. And the Fed is there telling everybody, well, it might be next year's story, or maybe one cut by the end of the year. So there's other things going on. But I've got to say that the most appropriate thing that Alan Greenspan, ever said was in 1996 at an FOMC meeting when he told Janet Yellen that the CPI is, in quotes, a flawed statistic. And what I found about these previous versions of the Federal Reserve, from Greenspan to Bernanke to Yellen, was they took a very eclectic approach towards inflation, towards supply and demand, towards the overall economic backdrop. And they did base policy based on their forecasts, not on backward-looking indicators. But you see what's happened here is that Jay Powell and his brethren at the Fed have everybody just focused on the CPI and the PCE deflator, even though these are lagging indicators. And the CPI in particular, which has been more problematic than the PCE deflator, is so dominated by the rental components. But that's what the Fed's looking at. I mean, when you go to the index of lagging indicators from the Conference Board, they have the leading indicators, the coincident indicators. Service sector inflation is in the index of lagging indicators. So we have a central bank, the world's most dominant central bank, is operating policy looking exclusively at coincident or contemporaneous and lagging indicators. And I find that to be a bit of a problem. And that's why I haven't walked away from the recession view, even though technically it hasn't happened yet. And Goldman Sachs is now forecasting CPI and PCE deflators to the second decimal place, 0.26. 0.32, 0.28. That's because the Fed has everybody on pins and needles over one number, which is CPI and PCE deflator, which are lagging indicators. And the market's become so hypersensitive that now you have the bellwether Wall Street economists at these big banks forecasting the numbers for the first time ever, publishing forecasts to the second decimal place. That is how anally retentive we become over these month-to-month price indicators, which are lagging to begin with. It boggles the mind. Everybody is just extrapolating what happened in the past year into next year. That's very dangerous. Everybody is living in the here and now and can't see past the tip of their nose. But you see, what I do is I do a lot of hardcore work on the pressures on inflation, the pressures. So that means focusing on aggregate supply, and it means focusing on aggregate demand. And what else do you want to ever hire an economist for? Because you could do this for anything. Now, we're just talking about the economy, but you could do this for commodities, you could do it for real estate, you could do it, for furniture and appliances, because every price is the intersection of supply and demand. And so it's a matter of when you're trying to determine the change in the price, which is inflation, how is the aggregate demand and aggregate supply curves moving in relation to each other? What do these curves look like? How are they moving? I know it sounds like I'm teaching an economics 101 course, but without that framework, you're lost. And all people talk about is the 12-month lagging trend in these price indicators. So I'm focusing not on that. I'm focusing on where my work is telling me inflation is going to be going in the next 12 to 24 months. In the US, we are going to be 2% or lower on headline and core inflation within the next 12 months. We will be at or below target, which is why I remain steadfastly bullish on rates and on treasuries. And the dips I'm buying are the price dips in the treasury market. Like we've seen, we'll get a hiccup because of supply. We'll get a hiccup because we get a couple of hawkish FOMC officials like Neil Kashkari. And there's nothing fundamental there. I think that the big surprise, especially because, and this was a Bank of America, their monthly survey of institutional investors globally that just came out last week, showed that something like 56% of investors believe that the primary tail risk is going to be an inflation resurgence, and only something like 23% believe it's going to be a recession. And those numbers should probably be reversed. By definition, looking at how investors are positioned and just looking at the market narrative is going to be, as we saw in 2009, inflation is going to be surprising people to the low side. And as you said, all people were doing, remember all the oil bulls back in the spring and summer of 2008, the narrative was what? The commodity super cycle. The narrative was perpetual double-digit growth in China and global decoupling from the United States. Well, that worked out really well.